Welcome. It's April 1st and 2020, and we're going to finish the Chapter 7 slides in Corporate Finance 1. And we'll see where we'll get to here. Well, we'll finish the slides. I know that we're going to do that. And then I'm going to do a second slide set, little homework problem or something for today where we do some practice problems because this isn't going to use up all the time. And it's always good to practice these problems, preparing for exams. And the exam this is chapter 7, and the exam is after chapter 8. So we're almost halfway through on our way to taking test 3, which covers both chapters 7 and 8. And that exam will be somewhere in the middle of the month of April. So we start with common stock equity. We're going to do book value per share. So we're trying to figure out the different ways to value a stock. Like we did the free cash flow model, and that works whether the firm pays a dividend or not. We did the zero growth model, which really pertained to a preferred stock. And so now we're going to think about what's the book value per share. And so what this is, it's the amount of if we sold each asset for its book value, in other words, what we paid for it, right? So a factory, we bought that years ago, we probably paid like a much lower price than it's worth. And so, but if we sold the assets for their book value, if we sold the factory, the vehicles, the equipment, if we sold them for what we paid for them and used the money to pay off all the debt, the current liabilities and the long-term liabilities, the bonds, and we divide it by the number of shares, we'd have the book value per share. So we're just trying to see how much did stockholders invest into the firm on a per share basis. And so this valuation technique does not reflect the market value of the assets, in other words, what they're worth today. It really reflects what we paid for them. An older company, we paid for them, 30, 40, 50 years ago, we paid for those assets. So we're really getting a value that reflects what we paid for the assets, what the firm paid for the assets historically. And so it's, frankly, it's not theoretically appealing way to value a firm. However, if you compare the book value of a share of stock, that's what investors have invested into each share, to what it's worth today, well, then you could see value added. So it's good to know the book value per share. And so it gives the amount investors invested into the firm, stockholders, common stockholders, but on a per share basis. So these problems are easy. Let me just show you what the given information is. So you're going to get like 3 pieces of information. 1, TZB has total assets of $25,000. On its balance sheet, assets total $25,000. That's the book value. That's what they were initially purchased for, like when we talk about those big fixed assets, like the factory and the equipment. That's what the purchase price of the factory was, plus all the other equipment. Not what they're worth today, but what they were purchased for. Think about like a house. Somebody might live in a house since 1992. And maybe the house is worth $1 million today, but they paid for it maybe $200,000. So the book value is what they paid for it, so to speak. Okay, so you have the total assets. That's what they paid for their assets when they bought them, presumably years ago for an older firm. It has total liabilities of $5 million. In other words, it owes its bond and its bondholders plus its current liabilities. The total is $5 million that we owe in debt. It has preferred stock of $2.5 million. So we'd owe the common stockholders $2.5 million. So if we sold the company for the book value of $25 million and paid off the total liabilities and paid off the preferred stock, we'd have what the common stockholders own, and then we would divide that by the number of shares outstanding. And so we take the $25 million, that's the purchase price of the assets combined, all the assets. We subtract out the amount of the liabilities, what it would cost to purge ourselves of the debt. We subtract out the claim that the preferred stockholders have on the firm of $2.5 million. And then we divide by the number of shares. So we get $5.83. What is that? That's on a per share basis, the amount common stockholders have invested into the firm. That's what they paid into the firm. Then we have the liquidation value per share. The idea is that we'd sell the assets for their market values. In other words, what they're worth today. That factory, we might have paid $5 billion for it in 1992, but maybe it's worth $20 million today. So when we add up the value of our assets, it's what they're worth today, not what they're paid for. And the accountants really don't keep track of that, so we'd have to get a list of the assets from them and then estimate the market value of each one of them. So we take the estimated market values and not the book values. So we'll do that on the next slide. Let me divide by the number of shares. So I'll show you the example. You'll be given some numbers. Here it's the same firm, but the market value of the assets is $42 million. We paid $25 million for those assets, but it shows us in this problem they're worth $42 million. We have the same liabilities. It's the same firm, the same preferred stock claim on the firm, the same number of shares. So you take 42 million. That's what we could sell the assets for today. If we wanted to bust up the firm. Sometimes they call this like a bust up value. If we sold all the assets, we'd get 42 million. We'd pay off the bondholders what we owe them, 5 million. We pay off the preferred stockholders what we owe them. Their claim on the firm is 2.5 million. And then we take what's left and divide it by the number of shares. We'd have $11.50 a share to pay out. So when we close our firm, we'd sell the assets for $42 million. We'd pay off the liabilities. We'd pay off the preferred stockholders' claim. And then we'd pay out $11.50 per share on the 3 million shares, and the firm could close its doors. So when they say liquidation value, it's kind of suggesting they're going to close the company, pay off the debt, the preferred stock, and then in this case, they'd pay $11.50 on a per share basis. So a guy who owns 10 shares would get $115. It's the value of each share, assuming we sell the assets at their market values and pay off the debt and preferred stockholders. We also often call it the bust-up value. The price-earnings ratio, we'll revisit that. The PE ratio is the price of the stock divided by earnings per share. The price of the stock divided by earnings per share. Example, the price of Target might be $18. Like if I looked it up today the market's doing well. This is actually Monday. But the market's doing well, and it's Monday the 30th when I'm making this slide set. But let's say Target today is selling for $18. And then we look at its income statement, its latest income statement. It's $1.50 per share. Its earnings per share is $1.50 on the income statement. Well, I would see that the price of the stock is 12 times earnings per share. It's like a multiple, we call it. The price of the stock is 12 times earnings per share. So the PE ratio for the firm is 12. And so the firm's stock price is 12 times its earnings per share. Well, we could use that, right? Like to value a firm, we could actually use the PE ratio. We looked at this a while ago, like in chapter 3 when we did statements and ratios. But here we're going to actually use the PE ratio. We're going to, play around with it a little, and we're going to use it to come up with an appropriate value for a share of stock. So if a firm is average in an industry whose PE averages 12, so maybe what's Target in retail, like Lowe's or Target, and you have Walmart and so on. Maybe in that industry, the PE ratio averages 12. And then we get the income statement out at the end of the year and we see earnings per share is $1.50. You could actually say, okay, the price of the stock, it should sell at 12 times earnings. So you take 12 times $1.50 and you get $18. And so it's a way to value stock. You take the earnings per share times the PE ratio that's average in the industry. Maybe if the company is a top player in the industry, you would take the PE ratio plus like 10 or 20% because there should be more optimism of a firm that's a top player in its industry. Remember, PE, when we discussed it a while ago, can be seen as a estimate of how optimistic stockholders are. The higher the PE, the more optimistic they are. The more they're excited about the future. So the stock should sell for 18 bucks. So here's a question. Assume Target has just announced its earnings per share at 240. These questions are easy. We give you earnings per share. Then we say, on average, the PE is around 17. Just multiply the two numbers together. So an estimate of the stock price is $40.80. So it's quite easy to use the PE ratio. We're not discounting like when we do D1 divided by RS minus G. We're actually finding the present value. Here, we're not doing anything like that. It's more like of a down and dirty technique. You take the earnings that were just announced, and then you figure out what the PE is that's typical in that sector. In this case, it's Target's retail. And you multiply the two numbers together, and that's an estimate of stock price. So this is one of those easy exam questions where you're given two numbers, you multiply them together, you get the estimate of the stock price, and you move on. So it's like a down and dirty technique. It ignores TMV. There's no time value of money discounting or anything like that. Okay, so that's the end of this slide set. What I'll do now is I'll make up a little homework slide set that we'll look at next, where you'll be able to work with some of the calculations along with me. And in any event, I'll talk to you in a bit.